Hello and welcome to our February webinar covering the USDA crop report and other developments. We've certainly had a lot of developments happen, and it's been a wild ride here since Inauguration Day with headlines coming out 24/7, just about every day of the week and just about every hour of the day. We start to wonder if our president ever gets any sleep. But while I'm talking, why don't I put up the disclaimer slide here for you? And let me say also that if you have any questions during the presentation, you can put them in the Q&A box, and we'll try to get to those questions at the end of today's presentation. But let's talk about this. First of all, again, price is a function of supply and demand as modified by the flow of money. So let's start out by talking about that money flow and what it's doing right now. And I wanted to open up just taking a look at our economy. We saw Federal Reserve Chairman Jerome Powell testifying to Congress this morning, to the Senate Banking Committee today. Tomorrow he'll testify to the House Financial Services Committee. That's something he does every 6 months. And he said we basically have a solid economy, and we have basically full employment. And he's not in any hurry to make another interest rate cut. And I would agree with that. I think he's gone too far already. But as we look at restaurant bookings, they're strong. TSA air travel data shows that airplane travel is strong. Daily debit card data shows strong consumer spending. The Atlanta Fed's GDP now is showing 2.9% gross domestic product growth in this first quarter. The Fed's weekly GDP index is at 2.5%. Both of those are solid numbers. Retail sales are strong. They'll get updated for the month of January on Friday. We'll get inflation numbers at the consumer level tomorrow morning, and inflation data at the producer level on Thursday. Jobless claims numbers continue to be relatively low from a historical standpoint. Hotel occupancy rates are strong. Bank lending to firms and consumers are just kind of going sideways. No real red flags there. Bankruptcy filings, the same thing. Credit and debit card data is solid. Gasoline demand is strong, meaning people are driving. Broadway show attendance is strong. Box office weekly grosses are strong. S&P 500 forward profit margins are at record highs. Business formation is weak because of a lot of the uncertainty right now with the Trump administration. And ASA temporary worker staffing index is weak. Employers are hanging on to employees. They're not hiring a lot of new employees, but neither are they laying them off. Layoffs are very low. And so it's just kind of hang on to the good employees you have. Don't let them go because it's hard to find new ones. But we're not expanding either. We want to see how this tariff situation plays out in the end and what that'll impact. We saw the small business optimism index come out this morning with a little bit of dip. It's still solid, but it's starting to show a little bit of concern. And as the National Federation of Independent Businesses said, businesses are still optimistic, but they're dialing that optimism back just a tad. So let's move forward here. Unemployment rate, 4%. That's historically a strong number. If we look at the consumer price data, and like I said, this will be updated tomorrow, and the first of the year is typically a time when we see inflation adjustments go up, because that's when businesses make adjustments to prices for the new year, and including also make adjustments in wages. And so it's not unusual at all to see inflation expectations go up. Keep that in mind when we get to our StoneX commodity index tracker. As we look at the CPI as how it's tracking versus this historical range in the 60s, 70s, and early 80s, it's just uncanny, the parallel here. Does that mean we have to go back up there toward 15% like we did in 1980? No, absolutely it doesn't. But human behavior does tend to repeat itself, so it's something we need to guard against. And in fact, Federal Reserve for a couple of years kept saying, we don't want to make the same mistake we made in 1980 by cutting rates too soon. And then they cut rates. Does that mean that we're going back up? Not necessarily, but let's keep an eye on it. Now, let's look at our fiscal debt. The Trump administration has developed the Department of Government Efficiency, known as DOGE, for cutting government spending. Our national debt is at $36.46 trillion dollars. Let me add a few more zeros onto that. Trillion dollars, as you see up here in the upper left-hand side. There we go. Got that circle kind of drawn there. If you look right over here in the middle at the top, we see that estimated tax revenue this fiscal year is a little over $5.02 trillion. And the interest in servicing our debt is currently at $1.043 trillion, which is more than we spend on defense and war. Now, 1.66 trillion on Medicare, and in Medicaid, 1.486 trillion on Social Security. You add up these four categories of Medicaid, Medicare, Social Security, defense and war, interest on the debt, and it comes to around $5.05 trillion. So we're already at deficit spending, and we haven't even touched the discretionary areas of the budget. The rest of them, like USDA, Veterans Affairs, Department of Education, and I could go on and on. Homeland Security, we haven't even touched those. And if you look at total spending in the current budget, it's right at $7.186 trillion, if you see this number right here. So far, the clock shows that the DOGE has cut about $80 billion. Their original goal was to cut $2 trillion from annual spending. Then they lowered it to $1 trillion. They got a ways to go if they're going to get there, but we're just in the first few weeks of their work. So we'll continue to kind of track that and see where it's at. Now, if we look at what's been happening with 10-year yields, they've been going up since September 17th when USDA started cutting its benchmark rate, which is the opposite of what they typically do in a rate cut cycle. And a lot of it is because of that runaway fiscal spending, fiscal debt that is starting to squeeze the credit markets. So if we look at it overall and summarize the bullet points, we currently have a continuing resolution to fund the government till March 14th. We still have to deal with the fiscal spending debt cap, which we're at that now. We hit it as it was reestablished on January the 1st. So Congress needs to act on that. That'll likely be part of the continuing resolution to fund the government going forward. But we're having a lot of disagreement in Congress on how to proceed on both of those issues. Now, we have seen the credit rating agencies in previous years, recent years, warn that if they see political inability to find a solution, that does risk a credit downgrade. And if that happens, that raises interest rates for all of us. The steepening of the yield curve that I indicated is a signal coming issues. Now, it's pulled back here in recent days, but trying to go back up again. Weakness in treasury auctions could occur without warning if investors are drawn elsewhere. And we have seen occasional auctions where that has happened, which took us up to around 4.6 or a little bit higher on 10-year yields. And as I mentioned, DOGE is currently cut so far around 80 billion or so, and that number is still constantly changing. That's tied to the commodities now. So on the right-hand side, you see the 5-year break-even inflation rate trending higher. And with that, we're seeing commodity prices kind of trending higher as well. A little bit of pullback in recent days, but overall kind of trending higher. If we look at it versus the 2-year break-even inflation rate, we're seeing a stronger push in inflation expectations there. Now, over 1.5 percentage points now for inflation expectations going up with the 2-year break-even inflation rate. And so we'll continue to track that. How does it compare to the CPI? The CPI continues to trend sideways to lower, but we are seeing commodities as a whole kind of trade trending sideways to higher. That's not every sector of the commodities, and I'll go into a little bit more in that. I've gone into more depth in previous webinars, but I'll touch on it a little bit today. Some sectors are going up more than others. If we look at grain and oilseeds, we're seeing a little bit of an upward turn there with the grain and oilseeds, but we see that strong 10-year correlation there of 0.88 still. Anything above 0.70 is considered to be a significant correlation. If we look at it versus some of the others, as I've been showing you this graphic, we know that the grain and oilseed sector, which is the poorest performing over the last couple of years, during 2023, they lost almost 21% of value. In 2024, it was almost 14% of value. Now, as we look at 12-month year on year, in other words, 365 days, this is what this graphic shows. So as we go back to where we were a year ago today, so to speak, the grain and oilseeds are kind of at a point now of breaking even, finally starting to pull out of that deficit they've been in recent years. The rest of the commodities are still showing some gains to varying degrees. Precious metals outperforming all the rest of them at this point, followed by the softs. Obviously, we've seen what's been happening with gold with the uncertainty that we see in the world. We've seen what's been happening with cocoa and the softs. And so that's been helping to elevate the commodity sector as a whole that I was showing you in those previous charts. Energy. We look at energy starting to get some better performance as well, although been going down here recently until the last couple of days anyway. Let's talk a little bit about the Trump election implications and update you on the latest. Last time we did a webinar, he was not yet in office, and wow, how things have really become active since then. We had the anticipated 25% tariffs put on Canada and Mexico and 10% on China until they do their part to helping close our borders to illegal immigration and drugs, namely fentanyl, or the ingredients that go into producing fentanyl. And that happened, but then right after it happened, we saw first an agreement with Mexico. President Sheinbaum stepped up and said, this is what we're going to do to help seal up your border. And Trump said, okay, we're going to pause for 30 days to see how that plays out. And then within 24 hours or so, Canada did the same thing. And we got a pause there for 30 days to see how it'll play out. 10% on China is still in place. They have put retaliatory tariffs and actions in place on a relatively small number of commodities, significant for those sectors, but insignificant in the big picture. That gave us some optimism. Maybe we're moving toward some type of trade agreement with them, but those things have kind of cooled. Things have kind of were going very warm between President Trump and President Xi Jinping, and now they've kind of cooled. I still anticipate that there will be a trade agreement. I think that China needs a trade agreement. But Xi Jinping doesn't, he's being very shrewd in his negotiation, and it looks like it's going to take some time for that to happen. Now let's go back to Canada and Mexico. I said from the start that I felt like there would be a relatively quick solution, and there was. So now we're in a 30-day period, and I anticipated that at the end of 30 days, President Trump would say, okay, we met that requirement. I said that probably wouldn't be the end of the tariffs with Canada and Mexico, because President Trump still likes to use them as a negotiating tool, and he still likes the revenue generating aspect of it. And we still have trade imbalances with Canada, Mexico, and China that are fairly significant. I think I got a slide in here to show that a little bit later. And he tends to migrate to talking about, whenever he's asked about Canada and Mexico meeting the obligations about sealing the border, he tends to migrate toward talking about the trade imbalance. And so this is leading to some question marks about what will happen at the end of the 30 days as we get into early March. Will those 25% tariffs go back in place, not because of border issues, but because of trade imbalance issues? And so that's a big question mark. And I think President Trump loves keeping everybody in suspense. He loves surprising the markets. He loves surprising other countries. It's that element of what to expect that I think he uses to his advantage. And so that's piece of the uncertainty that we have going forward. He's also indicated that there will be tariffs coming toward Europe, which we haven't seen anything toward at this point. He's indicated that today or tomorrow he would announce reciprocal tariffs against countries, that if a country's charging us a tariff, we will match that back. And then we have the universal tariffs that he's also talked about. So tariffs are likely going to continue to be in the news. I want to go back here to China. And I mentioned, I think we'll see a trade agreement. That's not because I believe that Xi Jinping is going to give in on his goals. We still have very different value systems between the United States and China, and I think Xi Jinping is going to stay committed to that. He plays the long game, and he's willing to give in on the short run to support his economy getting back healthy again. But long run, as soon as Trump's out of office, to be going back to want to make China number one in the world militarily and economically. If we look at U.S. soybean, wheat, and corn exports to Canada and Mexico, most of them go to Mexico, but you can see we're talking some pretty significant volumes that go to these two countries, and why the tariff issue is a big deal. Ethanol. Canada's our number one importer of ethanol. And so that makes a big deal to us all. Mexico also takes some. So far, they haven't been impacted by tariff talk or retaliatory action either, but this is something to keep an eye on. Here's that slide I told you about regarding the trade imbalance with China, Mexico, and with Canada. So China is the big one, followed by Mexico, followed by Canada. Canola imports coming primarily from Canada have been rapidly increasing in volume. Keep that in mind. A little bit later, I'm going to be talking about 45Z. Used cooking oil imports rapidly increasing over the last few years and making up about 55%, 52 to 55% of these imports are used cooking oil coming from China. Alleged used cooking oil, I should say. Here we show the numbers. Let's talk about the weather for a little bit. We see here this blue area in the equatorial Pacific representing that we're in a La Nina. The peak of La Nina seems to be past. We briefly had gone into a moderate La Nina. Actually, we had kind of a double peak into moderate La Nina. We're slipping back into weak La Nina now. Notice that we're still cool in this area of the Baja of California. The critical area that every time that we have a drought in the Midwest, or virtually every time, nearly every time, we tend to be cool in this area right here, cooler than normal. It's kind of an ugly C I gave you there for cooler than normal. And right now, we're a tad on the cool side. We've seen quite a bit of warming there, but it doesn't matter what it is now. What it matters is in May and June. If we cool back down in May and June, then that increases the chance that we see a high pressure set up right about here over the Midwest that blocks moisture from coming into the Midwest, that starts to heat things up and we get hot and dry. That doesn't happen very often anymore. The last time we had it happen to a significant degree was in 2012. So everyone always likes to talk about 2012. But keep your eyes on that Gulf of Alaska to see if that trend's cooler or not over the next few months. Now, again, we look back at November and December precipitation, wet across the center of the country in the Pacific Northwest. Much of that moisture in the middle of the country came in the first half of November, or even if not the first week of November. And wherever you see a 1, that means that that was the wettest period for that calendar time period on record out of 133 total years of records. If we look at temperature, it was very hot, very warm, especially in the south. Very typical La Nina type pattern, November, December. Now let's look at January 1 through February 10th, yesterday. And we see that northern Iowa has had the driest January, first part of February on record. It's been very dry. You see, it's been much wetter in Montana, and they needed the moisture up there, and they need more moisture yet to go. It's been very dry in the desert Southwest. It's been very dry along the eastern seaboard. Now, what about temperatures? Well, it's been generally on the cool side. We've had a lot of variation up and down, but this is what it's averaged. If you look at just January alone, we had some near record, not record, but near record cold down in northern Florida. As we got into February, we've warmed things up and pulled those numbers off of those upper one around the 130 levels. This is January 1 to February 10th. Soil moisture going down 16 inches, 40 centimeters. We see that in the eastern Midwest, we have a lot of dry soils yet. May have moisture on the top, but down below it's dry. The tiles aren't running. And same thing's true in the northern plains. In fact, much of the Midwest, frankly, and across south. Now, here over the rest of February, we should see a lot of moisture across the mid-south into the southeast. We should see a lot of rainfall in that area, particularly here in the days to follow. But can we fill those soil profiles in the Midwest before planting season? And I've shown you this before. I want to show it to you probably one more time. And that is if you look at all those growing seasons where we had a weak La Nina winter, the prior winter, and you make a composite map of what kind of weather conditions we had then from the May through August time period, the growing season, essentially in the Midwest, we see that it tended to be hot and dry, especially west of the Mississippi River, and even into the southern plains. If you look at years with a moderate La Nina, which we touched on a couple of times this winter, it gets even more intense. Notice that 2009 is included there. That was a very good growing season. So not every year was. It was basically 6 out of 10 years had a problem. 4 out of 10 did not, had good crops generally. It just says that the odds are higher that we could have a problem. So what about the next? Okay, I've almost said the next 2 weeks. What about weeks 3 and 4? And this map was made on Friday, the latest one available. It's showing wetness across the eastern Midwest and the southeast and in the Pacific Northwest. Equal chances over much of the rest of the country other than the dryness there in the Southwest, which we expect will continue to move to the north and east. Not very good at drawing arrows. Okay. That's the current thinking, is that dryness will continue to move to the north and the east. In fact, if we look at the latest European model, and this goes for May, June, and July, the first 2/3 of the growing season, shall we say, we see this tendency for drier conditions pushing to the north and the east, but we see generally wet conditions in the eastern Midwest. And that's kind of what it's looking like. We may have some occasional challenges in the eastern Midwest and maybe occasionally in the central Midwest with the narrow planting windows. I don't think at this point we see evidence that we're going to have trouble getting the crops planted, but we're probably going to have to take advantage of planting windows that we have. But what we're seeing is this continued push to the north and the east of the dryness that we currently see in the central and southern plains. Argentina. I've previously been talked about Brazil and their soybean, and that looks like that crop is about made now. We've got some southern areas that still need some more rainfall, but they're getting it. So we look at Argentina. We see that weighted rainfall from January 1 to February 10th, so this calendar year thus far, has been a little over 4 inches, about 4¼ inches, but it's been highly variable. If you look at the most productive area of Argentina, it's really in this area right here. And the crop ratings there are relatively good. Now, if I look at all of these areas and what do the NDVI scores show, you can see that we're below the long-term average, but we're still well within the range of normal NDVI satellite greenness issues. These areas that have been drier in here, they do have corn and soybeans grown in that area, but the concentration is not near as much as what it is further to the south and to the west. Much of this area is starting to get rainfall now, and we're really looking at dryness in this area and maybe some in this area as well, as I'll show you in a little bit. But overall, things have improved in Argentina. If you look at the next 2 weeks, we see that many of those areas are continuing to get rainfall over the next 2 weeks, while we dry out over Brazil's soybean belt, other than the southern areas where they still need some rain to help the crop finish, but we're drying out for harvest over much of Brazil's soybean belt. And that's been the biggest reason for the delays to this point, is being too wet for the crop to dry down and for harvest. And if you can't harvest the soybeans, then you can't plant the safrinha corn. We are starting to catch up, and we expect a lot more progress here over the next couple of weeks based on this forecast. This does not mean that this is totally dry over Brazil. It is tropical. There will still be rain, but it's below average. Keep in mind that average rainfall for this time of year is somewhere between 8 and 9 inches in center west Brazil for the month. So a lot of rainfall there, but much significantly below normal, allowing them to get field work to be done. Now, what do we see from USDA today? 50 million metric tons for Argentine corn, down 1 million metric tons from where they were last month. Soybeans down 3 million metric tons from last month at 49 million metric tons. I've been a little bit more conservative in reducing soybeans because I think they could still benefit from late rains. Will they? I don't know. I just tend to be more conservative in making my adjustments because I don't want to be going back and forth with my yield production estimates. The corn's probably reasonable because you've had some early corn pollinating. And so I could see that come even a little bit lower. Brazil corn coming down 1 million metric tons. Our customer survey says 129.4. USDA said that they reduced Brazil's corn by 1 million metric tons because the crop is getting planted late. But that's like cutting the U.S. corn yield in the May crop report because planting is 10 days behind normal. That is premature, in my opinion. Soybeans, they left unchanged. Now, if you look at our customer survey, it cut about 500,000 metric tons from its January estimate because of significant cuts in production in the south. And I think the rains may be helping now with a little of that. But those were largely offset by good yields in center west, the northern part of the belt. And so we're hearing some really good yields from that area that are offsetting some of the losses, many of the losses that we're seeing in the south due to dry weather. U.S. balance sheet, no change to corn, no change to soybeans, only cut 4 million metric tons off of wheat, still a very high number. That 4 million bushels was from higher food use for the wheat. And that is why the markets reacted negatively today. They made the adjustments on the world balance sheet, none of which made a difference on the domestic balance sheet, no need to ration demand. with higher prices when it's not impacting U.S. balance sheets and there's still adequate supplies. The funds got frustrated and they took profits. World ending stocks, we saw declines in wheat, corn, and soybeans. And you could make an argument that particularly the soybeans was a pretty significant decline, but it didn't impact U.S. exports. In fact, USDA cut about a dime off their soybean marketing year average cash price, while adding a dime to the corn, even though they made no different changes to their balance sheet. Export sales to unknown are now trending lower as we're starting to see those turn into shipments, and then they get designated to various countries as that happens. If you look at export shipments overall, keep in mind that the seasonal pace is that blue line, and we're still well above it, have been above it most of the marketing year. And that's why right now, marketing year to date, corn export inspections exceed the seasonal pace needed to hit USDA's target by 140 million bushels, and that gap keeps growing in size. USDA chose not to increase its export target for the United States today because it's worried about this being front-loaded demand, and to a great extent that's possible. I still believe that they could have raised it 25 to 50 million bushels and justified that pretty easily. They chose not to. I anticipate that come next month, we'll probably see an increase in exports. If we look at U.S. exports, Mexico, #1 export customer by a long distance, followed by Japan, followed by Colombia, another country that's been in the tariff news here of late. Ethanol use of corn continues to be relatively solid, as we've seen near record production this marketing year, particularly of late, with a little bit of a dip right in here because of weather there in January. So we're about 26 million bushels above the seasonal pace year to date needed to hit USDA's target. Exports have been holding solid. Corn major exporter carry out the use numbers on the low side. In here, what, about 17% stocks to use from the major exporters. But when you throw in wheat and combine them together, we're pretty low levels. And wheat and corn are very interchangeable in many parts of the world. It was interesting to note that USDA cut grain sorghum exports from the United States today by 50 million bushels, but then turned around and increased industrial use, ethanol production with grain sorghum, and livestock feed use by a similar amount, so that ending stocks of grain sorghum stayed basically the same. But they made no adjustment to corn ethanol use and corn livestock feeding to account for the increase in grain sorghum. If we look at where managed money is right now, we're looking at this blue line. Not quite a record level yet, but certainly getting close. And that's why the corn market struggled to hold today after USDA failed to provide any bullish fodder for sustaining those positions. See if they now defend those positions or not here over the coming days. If we look at our balance sheet, no change to USDA's ending stocks. I'm a little bit tighter. This export number still has notable upside potential. I'm 50 million bushels above USDA. The potential is there to go higher. I'm being conservative, just trying to see if we're being front loaded or not. Export target for the 25-26 marketing year is slightly below that. But if I use that 93.5 million acres for this coming growing season, that's up nearly 3 million acres. I use a 183 trend yield. I get 15.6 billion bushels, and I get ending stocks of just shy of 1.9 billion. There's nothing bullish about that whatsoever. But if we get any type of a weather problem that reduces this 1 83 bushel yield, then we tighten things up pretty significantly, particularly if we have a shortfall out of South America. Where I don't increase acres, and I'll leave it at 82.7, then things get a little bit tighter with a trend yield, and obviously much tighter if we have any weather problems that threaten that yield. If we look at soybean shipments, they were really running hot until change of the calendar, and then they've been running cold. And we built up a big surplus running marketing year to date to about 135 or 140 million bushels above the seasonal pace needed to hit USDA's target. Now that has shrunk to 82 million bushels above it. I still think we end up a little bit above USDA's target, but how much is yet to be answered for us yet. U.S. exports largely to China with about 22.5, maybe 23 million metric tons expected this year, this marketing year, but that used to be between 35 and 40 million metric tons. So it's really declined. You can see that Mexico comes in here as another significant importer, but nowhere close to China. Brazil simply has a currency exchange rate advantage. If we look at sales to China, they continue to ratchet down year by year. The only recent year that was lower is that 1920 marketing year. Yes, we had the trade war going on with China, but the bigger thing I would argue was African swine fever had decimated about 2/3 of China's hog herd, reducing demand. Soybean sales to unknown destinations continued to be very close to normal levels. Again, as I've talked about before, and I could take and move this, we're trending higher at a pretty good clip for soybean production in Brazil, and that really correlates well with the weakening of Brazil's currency. 2011, July of 2011, soybean futures at 13.50 per bushel, translated into 6.06 RIAs per bushel. Today, when I was working on this morning, we were trading around 10.50, around 10.49.5 at the time, so I rounded up to 10.50. I looked at the currency exchange rates at 10.50, was down 22% from what we saw in July of 2011. But the Brazilian farmer is getting almost 3 times as many RIAs per bushel at 60.8. That doesn't mean that's all profit, because their imported chemical and fertilizer has definitely gone up as well with their cheap currency. But there's still been a pretty solid correlation as the cheap currency has been supporting their industry. Soybean demand continues to be questionable. Chinese demand is flattening. One of our sources in China that's really has a pretty good track record believes that Chinese imports of soybeans this year are going to be down by about 11 million metric tons. And, about 11 million metric tons. They have been up the last couple of years because China's been building its reserve. And that's usually Argentine soybeans and Brazilian soybeans. It does not put Brazilian soybeans into its reserve because they ship wetter and they don't store as well. But currency exchange rates means that with flattening demand, what demand there is at China comes from Brazil first, followed by Argentina. And when they've run out, then they come to the United States. The other thing is domestic demand. I think domestic demand still has a lot of question marks. Question marks are because of lack of confirmation of any solid numbers for the 45Z subsidy level that feedstocks that go into production of these biofuels will get. There have been rumors in the industry that the Trump administration may accept Biden's 45Z guidance with adjustments. There's also some rumors that we may, quote unquote, see more favorable carbon intensity scores for soy oil and maybe even possibly canola oil as well. But fuel producers cannot operate a business on what may be happening in rumors in the industry. As a result, we've seen production pull way back. Biomass-based diesel production, we believe, is down 40% from where it was in December, with most of that reduction being with biodiesel. So we're waiting to hear from the Trump administration. We're just not a high enough priority for them right now. If we look at soybean balance sheet here again, no change other than USDA lowered their soybean price estimate by 10 cents down to 10.10, and I'll probably end up doing the same thing. If we look at managed money, again, the dark blue line, a modest long position there, not a huge one, but a notable one. If we look at the wheat numbers, we see that we have ample supplies of wheat, and we're expected to have ample supplies of wheat. We do expect that because of tightness of supplies now in the Black Sea, and some of the problems in Europe, that we are going to see improved export demand out of the United States as we get into the fourth quarter of the current marketing year. So that would be April, May, June, and into the first quarter of the next marketing year, which would be, it should be March, April, May, and first quarter of the next marketing year would be June, July, August. We do think we'll see increased export demand during that time period. Hard red winter wheat is still the big problem overall, but I wanted to show you this. This is looking at ending stocks as a percent of annual usage, in other words, carry out to use ratio, for the major exporters, excluding the United States. Because when these countries run out of wheat, then we start seeing increased export demand in the United States. And you can see that we're talking about it almost down to a 10% stocks to use ratio for these countries combined. And that's pretty snug on the world export market. Something we're going to have to keep an eye on, and why we felt like we would see some improved U.S. fundamentals as we get into the last marketing year, quarter of the current marketing year, and the first quarter of the next. Funds are still hold significant short positions in Chicago, Kansas City, and Minneapolis, although they've done more unwinding in Minneapolis. Note that the statistical correlation for Chicago and the fund position is very weak, 0.23. It takes to get up to 0.7 before it's significant. For Kansas City, 0.58, still weak. Minneapolis, a stronger correlation, but still not that significant. Take-home points today. Major exporter supplies of corn and wheat are snug outside the United States. We anticipated that would give us some pricing opportunities. It has. Now we're going to test the conviction of these traders in the days ahead. There's no need to ration demand with higher prices currently, but that could change in the weeks and months ahead, depending on how things unfold. Brazil is harvesting a big soybean crop, and U.S. demand remains suspect right now. Reinflation risks are creating some tailwinds. As inflation goes up, so does money flow into the broader commodity sector. That happens until it doesn't. And I go back and I use it as an example. Last spring, late April, inflation expectations coming back. Funds covered or short positions in grain and oilseeds. We got a headline out of the Fed that inflation is under control. And immediately we started seeing money pull back out of the grain and oilseeds once again. So it can happen without notice. Brazil does have a big soybean crop, no doubt about it. U.S. demand remains suspect. Reinflation risks, I mentioned, creating tailwinds. Weather risks are elevated for the 2025 Midwest growing season, but that's not a guarantee that we'll have a problem. Headline risks will remain high with the Trump administration. That's simply something that's going to continue to be with us. So with that, I'm going to close it out and ask if Victoria, if you would start reading the questions here while I get a little drink to soothe my throat.
Yeah, absolutely, Arlan. The first question we have is, how much can we potentially and realistically expect in reduction of federal spending by the work of DOGE?
Boy, that's a good question. And if you watch the news, you see that there's a lot of resistance to it. And what, regardless of what happens in Washington, ultimately it comes down to the voters. The last number I saw was that our annual deficit to GDP was at around 6.4%. Now, total debt to GDP is like over 120%. But our annual deficit is around 6.4%. In France, it was 6%. And they ousted their government because they tried to do some reforms to bring it down by a percentage point. Germany, similar actions. Canada, similar actions. So Washington still worries about getting reelected every 2 years in the House of Representatives, every 6 years in the Senate. And so it's very hard to get things done if it's going to hurt your reelection. And that's really what has to happen. Argentina is, because they're not done in the process, but they've made tremendous strides in this direction, but only because it got so bad with over 200% inflation that the younger voters got together and ousted the government and said, we want fiscal responsibility, cut our social programs so that you can cut taxes and get our economy healthy again. And so Argentina is being successful at it, but that was because they endured a tremendous amount of pain. I don't know that our U.S. consumer has endured enough pain yet to make it worth supporting their congressmen to make the cuts that need to be made.
Okay, our next question is from Marco. We haven't seen any flash sales of soybeans since January 16th, but no cancellation yet. Do you think that it will happen given the risk of trade war against China?
They don't really have that much on the books to cancel, but it's a good observation that you have there. They quit buying because they no longer need our soybeans. The soybeans coming from Brazil have been delayed, and so it's going to be late March before we see a significant uptick in arrivals in China coming from Brazil. And so in the past, they would have bought from the United States, from the Pacific Northwest, because it takes half the time, about 18 days, to get from the Pacific Northwest to Chinese ports, and they could have filled that gap there. And it looked like in first half of January, that's what they were going to do. But instead, what they've done is opened up their reserve that they built last summer. If you remember, I was saying they're really packing their reserve. And so they may lean on those reserve supplies rather than from the United States. And that's exactly what they're doing now. There were rumors inside of China that the phase one trade deal that came from Trump 1.0 might be revived. And we've even heard from the Trump administration and from the trade representative that he would like to revive that. And the rumors inside of China was that China might make an initial purchase of 3 million metric tons of soybeans and 2 million metric tons of corn as a goodwill gesture toward that end. And so that's what had us thinking maybe we were moving faster toward a trade agreement than what we had anticipated. I originally thought maybe it'd take 6 to 8 months to get a trade agreement, but then we started seeing all these developments and talk of calls and talking of pleasantries, and I thought maybe it will happen faster within 2 to 3 months. And then this rumor of China possibly buying, and that would have helped fill the gap. But last week, China started buying Argentine soybeans for March and April when their new crop will be available. That'll go into their reserve, and they opened the reserve up now, which they have plenty of soybeans in that reserve to help fill the gap until Brazilian supplies come, and have really shut down purchases in the U.S. And that is being translated or interpreted in China is that we're getting further away from an agreement in the near term. And that things are cooling down now again between the United States and China.
Given the use of ethanol in the corn exports, the corn American balance sheet should have been tightened further in this USDA report. Why do you think they haven't?
That's a good question. We fully expected it. Now, we have seen an increase in grain sorghum, as I indicated, that have been going into feed use here in the United States as well as ethanol production, because grain sorghum is so cheap since it has virtually no export program right now. But no adjustment for that either. And maybe that was the offset in USDA's eyes. I just think they decided to be conservative and wait until March or April to do that.
Given that in Trump's first administration, the tariffs on metal imports from the EU led to 25% retaliatory tariffs on U.S. corn shipments to the EU, what are your thoughts on a potential retaliation this time, given U.S. corn exports to the EU are trending higher?
Well, I do anticipate that there will be some retaliation, particularly as we look at Europe. Now, Europe is not a major customer because they don't like our GMO corn. So that is a problem, and one of the issues that Trump would like to address in a trade agreement that he did not get addressed during 1.0. But overall, as we look at the EU, I think that as far as we look at the 25% tariffs on steel and aluminum, Canada is going to be number one country impacted, Mexico to a lesser extent, some Asian countries. We actually import steel and aluminum for like 65 to 70 countries, so it's pretty broad in nature. But I do think that we'll probably have some retaliatory back and forth on tariffs with Europe, and that will have some impact, but not near as much of an impact as if it were from some of our Asian customers or Canada or Mexico.
Why is 183 still the trend line for corn in 25-26? Last year it turned out to be sub 180 with near normal weather.
I use a 30-year trend line yield for developing my yields. And there will be periods of time when we're below that and periods of time when we're below that. But I've been doing this for over 4 decades, and overall that's been the truest and the closest to what USDA does. USDA has periodically changed how they calculate trend yield. They'll go for 5 or 6 years with one type of trend yield, and then they'll change to a different type of trend yield. And I've just stayed with this over the last 4+ decades, and it has been most consistent for me in anticipating what the potential of the crop is. But good question, fair enough.
How many soybeans are in the books to be exported but have not been shipped?
That's a good question. I wish I would have looked up that number before I started it. Marco, if you could message me, email me, or message me with a direct message on X, formerly Twitter, I'd be happy to look that up for you and give you that number.
The last one I see here, Arlan, is waste of February was pouring as expected, which will be the drivers of the market until the March report.
Excellent question. A good way to finalize our questions now. At least so far, that's the last question. As we go forward, I think it comes down to planting progress of the winter or safrinha corn crop in Brazil, continuing to monitor production potential in the last half of the growing season for Argentina for corn and soybeans, and then starting to look ahead to the U.S. growing season. That becomes increasingly the focus as we get closer to March and into the month of March. And of course, we'll talk a lot more about that in our March webinar. March webinar, I believe, is also scheduled for the 11th of the month, so March 11th. And we'll go into all these factors that I just mentioned, in addition to updating you on the latest from the Trump administration, not just about tariffs, but geopolitical factors as well. And those factors that are market impacting. Look forward to having you all back at that point. Thank you very much for being here today. And for those of you in some of the areas getting some adverse weather in the days ahead, be safe and look forward to having you back next month. Thank you very much.